Shalom YouTube, you're listening to The Financially Savvy Chick. I am Tamar. In today's video, I want to talk about 3 ways you can lower your risk of losing money or providing a hedge over your finances. You have to know your tails. In a year facing an unusually wide set of outcomes, knowing what the risks are and how to hedge them is imperative. So I'm going to list 3 risks I see facing the global economy and 3 havens offering a refuge. Number 1, commodities and other real assets. 2, short-dated treasuries or cash. And 3, the US dollar. A non-legible risk facing markets this year and beyond is inflation, and it fails to fall back to a pre-pandemic level and remains stickier and more entrenched. Pretty much, a greater exposure to commodities and other real assets is essential. Commodities were the only main asset class to deliver a positive real return in the 70s. Stocks, corporate bonds, and U.S. Treasuries all posted negative real returns in that decade. Moreover, commodities, despite their post-pandemic rise, continue to be generationally cheap versus stocks and bonds. Commodities are a safe haven. Commodities can be oil, coffee, gold, silver, livestock, orange juice, and so forth. I'm not a financial advisor. This is my own opinion based on my own research. But I'm just offering and I'm just telling you guys of 3 things that could become a haven for you, right? And provide a hedge of protection over your money right now. Simply put, the investment community is still woefully underweight commodities, an asset that stands to be one of the few beneficiaries of persistent inflation. Using U.S. ETFs as a proxy, commodities are only 2% of the total invested in stocks, bonds, and commodities. Even a small redirection of flows from financial assets to commodities will lead to outsized gains in the latter. Commodities are also a hedge against rising geopolitical risk. Okay? Countries are seeking to fortify their accessibility to raw materials right now, essentially for energy, infrastructure, and renewable technologies. How best to find safety from a U.S. recession, and most likely of the 3 risks? Several reliable leading indicators are consistently with a recession beginning as early as this summer. Given the weight of the data in favor of a slump, it would be amiss not posit that one is likely. Treasuries, they are a haven of choice in a recession. Aside from their liquidity and the support they get from the rate cuts, they benefit from raw fear. If you know in a panic, people reach for U.S. Treasury debt, then it's rational to panic first. Bonds are generally gone up for most of the past 40 years, so any historical analyst will have that bias. Still, it's clear from the chart that you can find on the BLS.gov or the Federal Reserve.gov. It shows that treasuries on average see an acceleration in their rally after a recession begins. The caveat this time around is that we're in an inflationary world and bonds really may not rally as much as inflation in an inflationary recession. A way to mitigate this risk would be buying shorter dated USTs or cash, avoiding some of larger real capital losses that will come with longer maturity debt. Moreover, despite the recent rally USTs are still deeply oversold and speculators remain very net short, meaning any rally has the potential to be turbocharged in a flight to safety. The third major risk facing markets this year is a funding crisis, for which the dollar is a place of hedge. Cash is king, as they say. It remains the dominant currency in the international monetary system, despite initiatives to reduce the dollarization of the global economy, such as closer trade cooperations between China and Russia, and a muted expansion of the BRICS. It eclipses the euro, the yen, sterling, and the yuan in FX reserves, debt outstanding, and trade settlement. This can sound very confusing if you are not into finance, but it's actually not as complicated as it seems. The Fed thus remains not only domestic as a lender and of a last resort, but the international leader of the last resort. Yet the U.S. Central Bank is contracting its balance sheet with the place set to rise this year. The stickiness of the overnight reverse repo facility will ultimately ensure bank reserves bear the brunt of the QT, heightening risk that dollar funding becomes scarce and expensive. Disruptions to the dollar funding often become self-fueling due to structural dollar short inherent in the global monetary system. The dollar leads to falls in global cross-border lending in USD, as borrowers scramble to source dollars that are rising in cost, leading to default and deleveraging. The dollar will likely remain in a downtrend as long as the real yield curve keeps flattening. But it continues to be one of the best hedges if the dollar funding pressure arises this year, especially against EM currencies of countries with large external debt positions and sizable current account deficits, such as Turkey, Chile, and Hungary. I don't know why Venezuela isn't mentioned in this report. But markets face mounting risk this year, for instance, in the event China invade Taiwan. Although this is not discussed, such risk will likely participate at least one of the outcomes already highlighted. In any crisis, it's not about seeking what assets returns the most, but finding what loses the least, and commodities are the number one assets that you will have very little loss in. The options highlighted can't be guaranteed to offer a positive return, especially in real terms, but they stand in a good position to outperform other assets in the scenarios explored. A haven is defined as a safe or peaceful place. Unfortunately, 2023 is unlikely to offer any truly tranquil escapes but real assets. Cash, commodities, and just those two. They promise to act as sturdy life rafts when a storm hits. I hope you found this video helpful. I hope you are considering paying down your debt, staying out of debt, or getting out of debt. Either one. It wouldn't be wise to be taking on debt, especially if you're not in a position to pay it all off. The Bible says, owe no one nothing but love. Owe no man nothing but love. And so to be in debt is actually considered a sin. And right now is not a good time to be in debt. That's all I'm going to say. Hit the thumbs up if you like this video. Share this video. Don't forget to visit our website, thefinanciallysavvychick.com, and check out our blogs. Until next time, shalom.